All right, welcome to this week's edition of the Construction CPA's Coffee Cafe. I am the Construction CPA Lisa Raish, and we are dropping the hammer on cash flow problems so you can build things that matter. And today's topic is paying yourself as a business owner, salary versus draw. This is a really great question. This is one we get all the time from clients and prospects. So I think you'll find this one actually very, very interesting, kind of what the differences are, what it means to, different types of businesses and kind of how we figure out what makes sense depending on the type of business structure that you have. So um, it really does matter for a number of different reasons, the difference between salary and draw. It's going to depend on the type of business that you have. So how you're structured, right? Are you operating as a sole proprietor? Are you operating as an S corp or a C corp or, in a partnership? Each is going to have reasons for doing different things, and you need to kind of live within the structure of the entity that you have, and when you're determining like what portion of one or the other, or you're only getting one or you're only getting one of the other. Um, but it's a really good one to kind of hash out so that you understand, so that you don't get um, kind of sidetracked or not have chosen the right option for the type of structure that you're in. So kind of what does that really mean for you? So people do struggle with this all the time. I get it. Even clients that we've had for a while, we go back and forth with, the difference between the draw or the distribution, or, the salary, wages, W-2. Even then, we still have to go back and kind of reiterate what the differences are between some of these things and the reasons why we do some of the things we do. Um, if you're not exactly clear on the types of ways that you can pay yourself, those are the kinds of misunderstandings that can lead to IRS issues or even state related issues. So it's important that you understand the structure that you are in. So again, are you an S corp, a C corp? Are you structured as a partnership? Because at the end of the day, what ultimately can truly happen is, if you aren't clear on how you should be paying yourself, you could in fact create cash flow problems because you've created issues with taxation, and you've created problems with how you're actually taxed, the way that it's taxed, what is taxable, and then ultimately what your income tax rate is. And so it could ultimately, sadly, create cash flow problems at the end of the day, if you're not really clear on the difference between, again, paying yourself with a salary, a draw, so on and so forth. Um, it's going to potentially impact your income taxes. So most of our clients are in some type of pass-through type of entity. So it will ultimately fall to their own personal tax return. So again, there could be some potential tax liabilities there. Again, difference between salary and draw could potentially create issues with the type of retirement you're eligible for, how much you're ultimately eligible to contribute to a retirement to get you tax savings. So again, you want to make sure that you understand the difference between the two, so that you can, again, we use retirement. It's one of the kind of foundational tools that we use when we are doing tax planning for clients. So we want to make sure that you can ultimately capitalize on and maximize the amount of retirement you can contribute, not only to build your overall long-term wealth, but save you tax in the interim. And then also, it can have effects on how you grow your business. So if you're creating cash flow challenges because you don't understand the difference between paying yourself a salary and a draw and how those impact your business, you can ultimately create problems in your business that will not only give you cash flow problems, but you would not be able to grow the business that you want to, right? Or be able to grow it at the pace that you want to, because again, you're creating cash flow problems out of something simple as how do I pay myself as an owner? So kind of what are the differences between these two things? So a salary is going to be a fixed amount. It's going to be a scheduled payment. You are a W-2 employee. So you probably worked for somebody years ago. You got that paycheck every week, every other week. You receive that W-2 at year end. You are an employee of your business. Now, You cannot be an employee or a W-2 employee of all of these types of pass-throughs. There are rules on each of the pass-throughs and what you can and can't do in each. But a salary is simply that, like you would pay an employee. If you have an employee, you have a project manager, you have an office manager, that person receives a W-2. They get, paid every other week through the payroll service. That is a set, like you would be the same thing. I happen to own my own business. I am an employee of my business. I get paid every other week with the rest of my team. I get a W-2 at year end. So I am receiving W-2 wages. Owner's draw is simply taking money out of the business that are your profits that you previously had earned, right? You're taking a draw if you are a sole prop, if you are an S corp, we call it a distribution. Technically, it's still the same basic thing. You're taking, I earned a profit last year. I'm going to take cash out of the business and I'm paying myself that profit back. I'm taking a draw, I'm taking a distribution. That is just taking your profits from a previous period. You're drawing cash out of the business, you're taking a distribution out of the business. The fundamental difference between the two is the following. A salary is going to be an expense to that business. Revenue less expenses gets you to profit. So your salary is an expense to that business. Your salary, the payroll taxes associated with it are an expense to that business. Your draw, your distribution is not an expense to the business. Therefore, it's not reducing your taxable income. It is simply you are taking equity out of the business, equity that already exists from the business. And so that is the fundamental difference between the two. Both will ultimately affect cash going out the door because both are cash leaving the business. The difference is the draw or the distribution just simply is not an expense to the business. It will not reduce your taxable income. So for example, if you have a profit of $100,000 in your business, you take a draw of $50,000, that does not reduce the profit of that business by another 50. It does not. You have a profit of 100,000, you're taking 50 of that as your profit. Again, cash is leaving the door, it's coming to you as the owner. It is not an expense to the business. So that really is the first, I think, is the biggest misconception that we see that we have to explain to owners is that it simply is not an expense to your business. It doesn't bring that taxable number down any farther. And that's really kind of the fundamental difference between the two types. Now, there are going to be some other things we want to look at. So let's talk about when you take a salary. What does that mean? If you're taking a salary, you are a W-2 employee, you are going to be taxed as an S corp or as a C corp. Now, you might be an LLC filing as an S corp, and that's okay. But if you are taking a salary, you are in a corp type of structure, right? You're an S corp or a C corp, and you are actively working in your business, right? So again, we work with a lot of construction companies. So typically our owners are going to be kind of that project manager or the highest level of project manager in their business. They're supervising the projects, right? They're working in their business. They're out getting and generating leads. They're getting new projects. They're working actively in that business. We've talked about reasonable compensation previously on here, but when you are in an S Corp or a C Corp situation, you as the owner must be paid a reasonable compensation. There is not a hard and fast rule for reasonable comp. There is not, we get this all the time. Oh, if I pay myself this, I can take the rest in distributions and so on. The fundamental thing about reasonable comp that you need to understand is if you pulled yourself out of the business and you inserted someone else into the business to do the things you are doing in that business, what would you have to pay that person in order to get that job done? So for example, if you are in an S corp or SC corp type of structure for a construction company, you're ultimately acting as the ultimate business development person and ultimately the highest level, a project manager in your business. and you're paying yourself $25,000 a year as salary, it is not realistic to think that you could pull yourself out of the business and put someone else in for 25 a year and you would actually be able to pay them to do that. So if you pulled out that project manager and you hired a third party, someone you don't know, someone that isn't you, the business owner, what would you have to pay that person? And that's really the fundamentals of reasonable comp. There are other things that go into it. We do reasonable comp calculations for our clients, depending on what part of the country they're in, the size of their business, what they're doing in their business, and so on. Just remember, in that S and C Corp structure, even if you are an LLC filing as an S or a C Corp, you need to be, as the owner, paying yourself what's called reasonable compensation. And that simply means you are paying yourself a W-2 salary like you would every other employee. So if you're paying your people every week, you're paying yourself every week. You're having taxes withheld just like your team members have. It's no different. You're getting a W-2 from your business at year end, just like your project manager does, just like your office manager does, just like the laborers that work in your business. One of the kind of pros about taking a salary is it's predictable, right? So, for example, I'm a business owner, just like everybody else out here that we're talking to. I have a predictable salary. I get a paycheck every 2 weeks, just like a team member would get. So, again, it's predictable. You are paying into your federal and or state withholding if you are in a state that has a state income tax. It's easier to budget, right? I budget my team member salaries. I'm budgeting my salary in there with that, right? So when I'm creating revenue goals, et cetera, in my business, I'm putting my salary in there just like I would any other team member because I'm working in this business as well. And I need to ensure that, again, I have the budget to pay myself just like I would my team. So it's a great way to do that. Um, Again, like anything else, there are cons to everything. There are, there's compliance related to paying salaries, again, payroll taxes, the compliance, the W-2s at year end. Uh, so there'll always be that piece of it. Again, there's going to be a little bit more paperwork. You want to have yourself in your own systems just like you would have any other employee because you are an employee of that entity. So there's typically going to be a little more paperwork associated with that. Again, you're processing a payroll through your payroll system just like you would a team member. So there's typically going to be a little bit more work associated with that. But again, it's more predictable. You're putting money to the side throughout the year in order to cover any kind of tax liability that you may in fact have. That tends to be something we run into with clients. They've got withholding, from their salaries, which is super helpful. We're also, making sure that they're making estimates throughout the year for any potential tax liability they may have. So again, it just helps you to plan and budget and just create forecasts a little more clearly when you are in fact doing a salary that is, again, coming out every week, every other week, twice a month, whatever, however it is that you typically pay your team members. So there's really more of a predictability about that. Let's talk about a draw or a distribution, right? So your draw. So who's getting a draw? Typically, it's going to be that sole proprietor or the person who's got the Schedule C. So the sole prop, the LLC filing as a single member, which is filing a Schedule C, right? You're taking your profits out of the business. If you're in a partnership, you're drawing your profits out of the business. Again, that LLC that's filing as a partnership or that LLC that's filing as a Schedule C or as a sole prop is taking a draw of profits out of the business. Again, the profit does not reduce the taxable income of the entity. It's just simply you taking profit out. I've earned a profit of $1. I want to take 30 cents of that profit out. I draw 30 cents out of that profit. That is my profit. Like that is my draw of the profits. So that's all it's doing. I'm just taking equity. It's like when you take equity out of your house, you're taking equity out of the business. You're taking profits that you previously earned. The challenge with that, of course, is there's not going to be any tax withholding on there. So there's not going to be any federal or potentially any state if you are in a state with taxable income. So you are going to want to pay quarterly estimates if you can do that. I recommend it. It helps you to get your ultimate liability when you're actually filed down. But there's no money coming out, right? So you're just taking a draw. I took a draw of $5,000 out of my business for the profits that I earned, there is no tax on that. Like there's no tax withholding on that. So you have to be mindful that when you take those draws, you still should be putting money aside because you're going to have a tax liability somewhere down the road. Again, it's a little bit more flexible. So you could, take a draw once a month or, once a week, or, I take a draw every other month. Again, you have the flexibility to do that. Especially if you go through periods in the business where maybe you have a little more cash flow or profitability is higher at certain parts of the year. You can be a little more flexible with drawing here and there. Again, when you are being paid a salary, it's weekly, biweekly, bi-monthly, whatever your cadence for paying is how you're getting paid. The downside of the draws is that it can complicate your overall personal budgeting. So, there are times where you need to have certain amount of money coming into your home, right? You're just like anyone else. You need to have cash flow coming into the house to pay your rent, pay your mortgage, whatever it is, whatever your household expenses are. So while it could be nice and it's flexible where you can draw whenever, it could complicate how you personally budget because there are aspects of your own personal budgets, your own personal home finances that are going to have a cadence to them. They are going to be monthly. You have a monthly mortgage or a monthly rent or a monthly car payment, whatever it happens to be. So again, that can complicate it if the draws are not consistent, or they're not coming consistently throughout the year. Again, I just mentioned a little while ago, you might forget to save money for taxes because you are going to ultimately owe some sort of tax liability. So just because you took a draw of $5,000 out of your business doesn't mean the entire five is yours. There's actually a portion of that you have to think about putting to the side because there is going to be a tax liability somewhere down the road. So needs to be considered a little bit more strategically when you are kind of thinking about the draws and distributions. So the different kind of who's eligible for what and why, right? So how these various business structures affect how you pay yourself. So if you're a sole proprietor, you are filing a Schedule C. You're simply taking a draw from your business. You're taking a draw of profits from your business. There's no timely cadence to it. It's just you're taking draws. You cannot actually be a W-2 employee of your business if you are a sole proprietor. So that is something you cannot do at all. Now, if you are a single member LLC, a single member LLC defaults as a Schedule C for tax purposes because, again, the LLC does not exist for tax purposes. It is simply a legal vehicle. So you have to choose, you have to have a way that you are taxed. So the default when you're one person in an LLC is you automatically default to being a sole prop, like a Schedule C, filing for tax purposes. So you're going to be just like the sole prop we talked about. You're taking draws of profit out of your business. Now, what if you're a multi-member LLC? Well, you've got two or more people in that LLC. You're at the minimum defaulting to be a partnership. So if you're a partnership, you're taking a draw out of the business, same thing. You cannot be an employee of your business when you are a partnership. You're taking draws of profits. You can have employees. You just cannot be an employee of your business. And so you're taking a draw or you're taking your share of the profits when you are a multi-member LLC. Now, you could be an S Corp. You could be a straight S Corp. You could be an LLC filing as an S Corp. And that could be one owner. That could be multiple owners. And when you are in an S Corp situation, you are taking typically at the minimum your reasonable comp first. So you're taking a salary first. And then potentially, if there are profits to, in fact, distribute to you, you are or can be taking distributions of your profits out of that business. There's no hard and fast calculation for like what percentage of each one. People will say sometimes 50-50, 60-40. We typically will run a reasonable comp analysis first and foremost to ensure that our clients are paying themselves a reasonable compensation. And then we determine what the distributions over and above that could potentially be based on the fact that we are comfortable with the the owner is paying themselves a reasonable compensation. When you're a C Corp, it's going to be very similar. You're going to take a salary. Again, same thing, reasonable compensation. If you were not the one doing the thing in your business you're doing and you hired somebody to do it, what would it cost you to hire that person? And that's really the way that you need to look at reasonable comp. Now, any kind of profits the business may have, you can have those profits or those dividends distributed to you. Again, there are tax consequences of all of these different things. If you, in fact, have profits to potentially share or, distribute out as dividends to your owners, you want to make sure that you understand all the tax implications of all of these various structures and why you're in them, because each of you is in those structures for a specific reason. You want to just make sure that you are following along with the rules of the structure you've chosen. For example, let's just go back to the S Corp, C Corp. If you're not paying yourself a salary at all and all you're taking is distributions, you're not paying yourself a reasonable compensation, and therefore you are leaving yourself open to an audit situation because the IRS, as well as other tax authorities, believe that the business needs to be run by somebody being paid a reasonable salary, and therefore you need to pay yourself a reasonable compensation. So you need to be very clear. And again, if you're a Schedule C, if you're a sole proprietor, you cannot be an employee of your business. You can have employees, but you yourself could not be that employee. So you want to make sure that you're very clear on the structure you have and very clear on what the obligations from the paying you perspective have on that various structure, and you are living within the lines of what that structure happens to be. So what's the right method? Again, what business structure are you in? You're going to make sure that you understand the type of structure you're in and what you are eligible to receive in that structure. You want to look at your profits and your cash flow. Like anything else, if you don't have cash to pay yourself a salary, you definitely don't have cash to take a distribution out of your business. So you want to make sure that you're very clear on your business's profitability and your cash flow. It's going to affect you and the way that you've paid yourself no matter what, whether it be in that predictable salary every week or in the draws when you take them and your ultimate tax liability at year end. You want to make sure that you understand the scope of the type of structure you're in and how taking out of that structure will ultimately affect your cash flow and the profits in that structure. Always consider the tax obligations and the implications of the structure you've chosen. Each one is going to have different rules, different ways that you are taxed, different, various rates and so on. So you want to make sure that you're very clear. I am an S Corp. I pay myself a salary. I am taking distributions over and above of the profits, et cetera, et cetera. What are the tax implications of that structure for me as a business? And then if we are a pass-through like an S Corp, what does that mean for me personally as an individual? Same thing, C Corp, right? What does that mean for the entity? What does that mean for the structure of that entity, the taxability of that entity, and therefore you as the owner as well? As always, we recommend that you talk to your CPA, your EA, whoever is supporting you from a tax perspective, as well as an accounting perspective, to ensure that you have the cash flow to do what it is that you need to do, but then also understanding what your potential tax obligation may be, because that tax bill at year end could be quite sizable if you have not really considered all of the aspects of how you have paid yourself throughout the year and what you've actually paid yourself. Always, let's talk a little bit about best practices. Again, I will always reiterate this for paying yourself. You need to separate your business from your personal accounts, regardless of if you are taking draws out of the business or you're taking a salary out of the business. You are on salary, you're on payroll, you get a paycheck every week, every 2 weeks. The money leaves the business account and pays you into a personal bank account, just like any other employee. Money comes out of the business, goes into the personal. You take a draw out of the business, you take a draw of your profits, you pull the money out of the business account, you put it in your personal account. You're paying your mortgage out of your personal account. You're paying your car payments out of your personal account. You're paying the kids' tuition out of your personal account. You do not commingle those expenses with your business. That opens up a whole other area of legalities and opening yourself up to reasonable comp issues, as well as negating the structure of your business, which we are not going to talk about on here today. But you need to separate. When you look at your book, your distribution summary for the year should be distributions of full dollars, round dollars coming out every, whatever, every period of time. It should not be, oh, paying the kids college tuition and we're paying my personal credit cards out of the business. No, you take a draw of 5,000, 10,000, whatever it is out of your business. You move the money to your personal account. You pay the kids tuition out of your personal account. You pay your credit cards out of the personal account. You go to dinner with your husband or your wife from the personal account. You do not commingle those. Makes a big mess from an accounting standpoint and can open yourself up to tax liabilities down the road. You got to be consistent about it. Again, sometimes I take a distribution, sometimes I pay my personal expenses out of the business, etc. Again, keep them separate. Always set money aside for your taxes. Good, solid, profitable businesses are paying taxes. We are doing the best we can to save you wherever we can, but you are going to be paying some tax and you've got to put your money to the side, because at some point when you go to file that tax return, there's going to be a liability or obligation that you're going to have to meet. It's a lot easier to meet that obligation when you know you've got some or all the money put to the side. Again, we hate to see clients get into installment agreements year after year where they owe so much money and they're paying, down their balance. We would rather see you owe and pay your liability right up front. And that way, we're not opening yourself up to, additional long-term penalties and interest and paying extra, which we don't want to see clients pay extra money on their taxes because they simply didn't put money to the side to pay the liability. And as always, just reevaluate as your business grows. There may be things in your business, as you grow, you get larger, things change. Sometimes the structure changes. Sometimes the things you're doing in your business changes. So it's not a one size fits all. It's not a, we're like this today, we're going to be like this tomorrow. There may be things that change. So, take a look at what has changed in your business and make sure, you're looking at that and really looking to, well, where am I looking to go with this? And what do I have to change in order to make it align with what my overall goals are? As always, please feel free to drop questions in the chat. We do love to hear from you. If you would like to follow us on, let's see, YouTube, Facebook, Instagram, I think we're everywhere now, it seems like. We are at the Construction CPA on all of them. As always, I look forward to seeing you here every Friday. Have a wonderful weekend, and we'll see you here next week.